Good morning, everyone, and welcome to FSM Expo 2023. So I remember very clearly that the last time that we held this event was actually back in January 2020, right before COVID-19 shut everything down. So it's been a good 3 years since we saw everyone already. And on behalf of the team here at FSM1, I'd like to welcome everyone back. It's really good to see you guys again. So my name is Jun, and I'm with the research team at iFAST. And to kickstart today's presentation, I will be sharing our investment outlook for 2023. And as you can see on the slide over here, we have prepared a total of 10 points for our outlook this year. But unfortunately, because of time constraints, I will not be able to go through all 10 points in detail. However, the good news is that many of these points, they will be covered by my colleagues in the sessions later on, so please be sure to stick around for them. So my objective today is actually very simple, and that is to give you guys a better understanding of where we are in terms of the global macro environment, what to expect going into 2023, and more importantly, I will also be sharing some tips on how you can position your portfolios given what we are expecting. And hopefully after this, it will leave you in a better position to manage your own portfolio. So without further ado, let's get started. So before we jump into our outlook for 2023, I want to do a quick throwback to our mid-year review event that was held in July last year. So what you're seeing on the screen is actually a screen grab from the event. That is actually me sharing the investment outlook as I'm doing today. And if you look to the right-hand side of the screen, you can see that the title of my presentation at the time was, "Your mortgage rate is about to spike to 5%. And at the time, we were doing some analysis on interest rates, and even though we thought that a 5% mortgage rates projection was slightly aggressive, it was nonetheless appropriate given the unrelenting pace of Fed rate hikes. But since then, what we have seen is that many banks, they have started to pull fixed rate mortgages off their shelves only to reintroduce them at higher rates. And if we fast forward to today, fixed rate home loans, they are currently as high as 4.5%. And with the 3-month SORA crossing the 3% mark in December last year, floating rate loans, they are not far behind either. So as a matter of fact, one of my colleagues just shared with me earlier in the week that her monthly mortgage payments have gone up by about $1,000 from the beginning of last year compared to this year. And that is a substantial increase during a period of 1 year. And I'm sure that those of you here who have bank loans will be able to relate to this as well. And judging by the way things are going, 5% mortgage rates may soon become a reality. So I think the question on everyone's minds now is, how did we get here? And the short answer to that question is because of inflation. And that leads me into the first point of our investment outlook, and that is inflation and interest rates will likely stay higher for longer. Now, there are two parts to this point, so let's talk about inflation first. So you might have heard of the saying that inflation is the number one enemy of central banks, and that is certainly the case throughout the past year and a half, as many central banks, they struggled to bring down inflation in their economies. So in the US, you can see that consumer price growth, they grew at a rate of 9.1% in July last year. And even in the Europe, consumer prices, they were still in the double digits at about 10.6% in October last year. So this surge in inflation is actually driven by a number of factors, such as the excessive amounts of pandemic stimulus, supply chain disruptions, and of course, the Russia-Ukraine war. And even though inflation has since moderated in the recent few months, it still remains well above the central bank's target of 2%. And while some market participants, they are under the impression that inflation is going to fall magically back to the target rate of 2%, we don't think that is likely. So we think that inflation is in a structural shift, and the decades of low inflation, they are probably gone for good. In other words, inflation is going to stay higher for longer. And here are a few reasons why. So first of all, let's have a look at the energy sector, in particular the oil and gas industry. So since the start of the Russia-Ukraine war, oil prices, they have pretty much gone on an uptrend, reaching as high as more than $120 per barrel back in June last year. And even though oil prices, they have come down notably since then, they still remain significantly higher compared to pre-pandemic levels. And aside from one of the obvious reasons driving oil prices higher, that is the Russia-Ukraine war, another reason keeping oil prices higher is also because of a structural underinvestment in oil and gas assets. And if you look at the chart over here, you can see that in 2021, the annual investment in upstream oil and gas assets amounted to $350 billion. So make no mistake, $350 billion, it is an incredible amount, but it still pales in comparison with the amount that was invested back in the early 2010s, as you can see over here. And this is considering the fact that fossil fuels, they still account for 80% of the world's energy. And the reason for this underinvestment is largely due to ESG concerns, as more countries are starting to move away from fossil fuels and towards clean energy. While I personally think that this move is certainly a step in the right direction to meet our climate change goals, it is unrealistic to expect that these changes will materialize overnight. So for one, the generation of renewable energy has not been keeping pace with rising energy demand. And until this transition is complete, the world will still have to depend on fossil fuels for the time being. And on top of that, the green transition is also likely to contribute to longer-term inflation, as it is likely to create a huge boom in demand for rare earths and strategic metals that are used in electric vehicles and also other forms of renewable energy. So, moving away from energy and onto food. So food prices, we think that they are also going to be higher for longer. So the Russia-Ukraine war is obviously one of the key drivers of food inflation as well, as both countries, they combine to supply nearly 1/4 of the world's wheat. So back in November last year, both sides actually agreed to a 4-month extension of the Black Sea grain deal, and that has actually brought some relief to food prices in recent times. But what we have learned multiple times in the past is that these changes, things can change in an instant, and there is no guarantee that food prices will not rise again. And to make matters worse, food protectionism is also on the rise as governments, they try to safeguard local food supplies, adding to inflationary pressures. So if you think back to last year, there might be a point in time where you walked into NTUC and you realize that the price of chicken meat has gone up by 20, 30, maybe even 50%. And the reason for this is that Malaysia actually implemented an export ban to stabilize domestic prices. So aside from this, Indonesia's ban on palm oil and also China's fertilizer ban, these are some examples of how rising food protectionism can actually add to food inflation. And last but not least, extreme weather patterns, the impact of climate change, they will also continue to challenge agricultural use and contribute as a long-term driver to food price inflation. So last year, we have seen many instances of extreme weather patterns such as droughts in the US and also severe heat waves that wiped out hundreds of acres of crops. And finally, shortages in the labor market, they are also giving rise to wage inflation. So even after several rounds of rate hikes, the US labor market, it continues to remain resilient. As of November last year, there are nearly 1.7 jobs available per person registered as unemployed. Job gains, they continue to beat expectations, and the unemployment rate remains low relative to historical standards. So thanks to this resilient labor market, workers, they have greater bargaining power, leading to wage gains. Rising wages also means that the increased cost of labor for companies, they will eventually have to be passed on to consumers in the form of higher prices, thereby fanning inflation. Now, we've talked a lot about inflation, let's move on to interest rates. So a resilient labor market and stubbornly high inflation leaves the Fed no choice but to continue tightening. In a span of 9 months, the Fed has actually raised rates by a total of 425 basis points, making the 2022 rate tightening cycle the most aggressive since 1980s, as you can see from this table over here. But aside from the Fed, central banks across the world, they are all tightening in unison, as inflation in many countries hit multi-decade highs. As a matter of fact, monetary policy has never been so overwhelmingly tilted towards rate rises in the past 5 decades. And synchronized tightening, this can be extremely hurtful to an already fragile economy, especially when consumers and businesses are already under immense pressure from higher inflation and borrowing costs. Now, with both inflation and interest rates likely to stay higher for longer, this brings me to my second point, and that is a global recession is likely unavoidable. So across the world, tighter monetary policy is starting to bite. Over in the US, the leading economic indicators index has been on a downtrend since June 2021. On the other hand, CEO confidence, which is another measure of the health of corporate America, is at one of the lowest levels since the GFC. And as a matter of fact, there are 98% of survey respondents, they are actually expecting a US recession to occur in the next 12 to 18 months. Things are even worse in Europe, with more than 99% of respondents expecting a recession there. So both these measures, they suggest that economic growth is likely to deteriorate further in 2023. However, the US is not the only economy to face a slowdown in business activity. With global growth slowing, PMIs across most major markets are also on the decline, as you can see from the chart over here, which shows you the global composite PMI index under the 50 line, which indicates a contraction. And this also reflects the headwinds that are faced by many countries in the global economy. And to make matters worse, consumer spending, which accounts for roughly 2/3 of US economic growth, is expected to decelerate as households they continue to face a mix of high inflation and soaring interest rates. So if you draw your attention to the blue line on the chart, you can see that the savings rate in the US has actually fallen to a low of 2.3% in October, and that is way below the pre-pandemic levels of about 9%. So if you're wondering why the savings rate actually spiked in early 2020, that is because those were the early days of the pandemic. Most people were stuck at home, they were unable to travel, go out and spend, which is why you see savings shooting up. But since the US economy started to reopen, that's why you see savings coming down to the level that it is today. Now, if you draw your attention to the yellow line on the chart, it shows you that credit card balances in the US has actually reached a high of $925 billion in the third quarter of last year. And that is actually close to the all-time high that was set back in 2019. So what this tells us is that inflation-wary consumers, they are starting to rely on credit and savings in order to keep spending. And this is a trend that we think is not sustainable, especially if inflation and interest rates are likely to remain high. Furthermore, the yield curve, it remains deeply inverted and it signals a recession. So since 1980, every recession in the US has been preceded by an inverted yield curve. So if you look at the chart, the 10-year minus 2-year Treasury spread has successfully predicted all 5 recessions in the US with only one false alarm in 1998. The 10-year minus 3-month Treasury spread is even more accurate, having predicted all 5 recessions also, but this time without a single false alarm. An inverted yield curve, it is considered to be one of the most consistent and reliable indicators of a recession, and the likelihood of a recession, it tends to be greater the deeper the inversion and the longer the curve stays inverted. And as you can see, as of December, the 10-year minus 2-year Treasury spread is currently at about negative 50 basis points, and it has been inverted since July last year. On the other hand, the 10-year minus 3-month Treasury yield curve is also inverted at negative 65 basis points. And if you look back to 2008, you can see that the magnitude of the current inversion is actually already deeper than 2008. How long will the curve stay inverted for? Only time will tell. So outside of the US, Europe continues to struggle with high levels of inflation, with consumer price growth still in the double digits as of November last year. So the ECB has since responded to high inflation with multiple rate hikes, marking a shift away from the negative interest rate regime that it has adopted over the past 10 years, and this is a move that will likely weigh on growth. So Europe is also in a precarious position given its heavy dependence on Russia for energy, and with the Nord Stream 1 pipeline to remain shut indefinitely, and as we head deeper into the winter months, an energy crisis looks increasingly likely. And if one materializes, we can expect massive production cuts to hit Europe's manufacturing industry, and that will inevitably result in lower economic growth. So China, on the other hand, it is also not in a position to boost global growth. After the conclusion of the 20th National Congress back in October last year, there are signs that China is starting to lean towards a more state-controlled economy as opposed to a free market economy. On top of that, geopolitical tensions are also escalating dangerously as China goes head-to-head with the US over issues such as trade, semiconductors, and of course, Taiwan. On top of that, COVID cases in China, they are also on the rise after China basically abandoned its COVID-0 policy overnight. However, vaccination rates among the elderly is low, and the healthcare system is not equipped to handle a large surge in hospitalizations. As China becomes increasingly isolated from the world, coupled with weak domestic demand, its economy also faces stagnation. So all in all, with most major economies on a much weaker footing than before, we think that the question of a global recession, it is no longer an if, but rather a when. And with global growth slowing sharply, our base case is for a recession to occur in 2023. However, this upcoming recession, it is unlikely to be as severe as the one that was experienced back in 2008. as the balance sheets of households and businesses, they remain strong. On top of that, the financial system itself, it is also on a much stronger footing than before. And last but not least, inflation-driven recessions, they tend to be milder compared to credit-driven recessions. Now, with points 1 and 2 out of the way, let's talk about some ways that you can position yourself given the environment that we are expecting. So going into a recession, we believe that a more defensive positioning is warranted. Therefore, in terms of asset allocation, we have a preference for fixed income over equities. So widening credit spreads combined with monetary tightening have pushed bond yields close to levels that were last seen during the GFC. And as of December last year, the yield to worst on the Bloomberg Barclays Global Aggregate Index is about 4%. And this much higher than normal yields today, it actually creates an opportunity for investors to receive higher total returns over time. And on a relative basis, the valuations of fixed income, they have also turned much more attractive compared to equities. So if you look at the chart over here, it shows you that the spread between earnings and bond yields have contracted substantially, and it is now at about 3.2%. And that is one of the lowest levels on record and also more than 2 standard deviations away from its historical average. So what this chart tells us is that at this point in time, equities, they are relatively less attractive compared to bonds, which is why we favor fixed income over equities. And within fixed income itself, we prefer investment grade over high yield and short duration over long duration. So let's tackle the credit quality first. So going into a recession, we believe that a more defensive positioning, it should be important. And investment grade bonds, they are likely to outperform their high yield counterparts, as the latter is likely to experience greater credit spread widening as economic conditions continue to deteriorate. And in terms of duration, our preference here is actually for short duration bonds. So the reason is because yields on short-term bonds, they have moved up significantly higher compared to longer-term yields, which implies that investors can actually receive higher total returns over time without having to take on greater duration risk. So in Singapore's context, just think of our T-bills, where T-bills are offering you 4.2%, while the 10-year Singapore is about 3 plus 4%. So that's what I mean. So more details on our fixed income outlook will be shared by my colleague Hui Shi right after this. Now, moving on to equities, we expect value stocks to continue outperforming growth stocks in 2023. Value stocks, they tend to do well during periods of high inflation and rising interest rates. And in a rising rate environment, we think that investors should actually look to reduce the equity duration of their portfolios by favoring stocks that derive the majority of their valuations from current fundamentals, aka value stocks, rather than those that depend on earnings that are way out into the distant future, aka growth stocks. The current macro environment, it also remains supportive for value stocks but challenging for growth stocks, and we do expect this environment to persist, especially as inflation and interest rates are expected to stay higher for longer. Furthermore, value stocks, they have been a lot more resilient compared to growth stocks, as they have experienced much smaller negative earnings revisions compared to growth stocks during this economic downturn last year. Last but not least, value stocks, they continue to trade at a wide discount to growth stocks, and that further increases their attractiveness. And even though we think that investors should adopt a value tilt in their portfolios, that does not mean that you should ignore growth stocks entirely, especially given the sharp sell-off in growth stocks last year. So tech stocks, which constitute a huge universe of the growth stock universe, will remain relevant in the long run, especially as the world we live in becomes increasingly digitalized. So that's it. Investors who wish to retain some exposure to tech stocks, growth stocks, should opt for high-quality tech names with strong profitability and balance sheets. So moving on to point number 6, following our downgrade of Chinese equities, developed markets, they now look more attractive compared to emerging markets. So within the developed market space, we have a preference for US and Japan. Japan, it is currently our top pick because of its accommodative monetary policy, the positive impact from reopening of its borders, strong pricing power of its companies, and of course, attractive valuations, all of which favor an upward re-rating for Japanese equities. As for the US, even though we are expecting a recession to occur in 2023, it is likely to be mild, as I have explained earlier. So for investors who wish to retain exposure to US equities, you can consider a value tilt for the reasons that I've highlighted in point number 5. Meanwhile, Europe will most certainly enter a recession in 2023, and is the least attractive market amongst developed markets. High inflation, rising rates, and the threat of an energy crisis will inevitably result in lower or worse negative economic growth. So moving on to China. As some of you may already know, we have recently downgraded China to a rating of 2 stars, not attractive, back in November last year for a number of reasons. So first of all, China is leaning towards a top-down state-controlled economy as opposed to a free market economy. And with SOEs now prioritized over private companies, the long-term profitability of the private sector is now at risk. Secondly, geopolitical tensions with the West, they are also escalating dangerously as the US goes head-to-head with China over the issues that I've mentioned earlier. And with China abandoning its COVID-0 policy, hospitals, they are overwhelmed, people are staying home for fears of contracting the virus, and along with a property crisis, domestic demand remains weak. So overall, investing in China today comes with significantly higher risks, and that is why we have factored in a higher country risk premium for China. So more details on our outlook for China will be shared by my colleague Wei Ren in a session later on. Moving on to point number 8, we have 3 tactical ideas for you to consider for your supplementary portfolios. So the first is ASEAN equities. So ASEAN is one of the regions that will benefit from a shift in supply chains away from China. Despite an economic slowdown, the region's economic data has remained robust, and we expect growth in the region to remain relatively resilient amidst the reopening and recovery. So ASEAN inflation is also relatively milder compared to other major economies such as the US and Europe. Thus, we expect a less hawkish response from ASEAN central banks, and that should be more supportive towards ASEAN growth as well as its equity performance. So for our second tactical idea, we have commodity-linked equities. So given our expectations for commodity prices to remain higher for longer, we think that investors should get some exposure to commodities. So energy prices, like I've explained, they are expected to remain at elevated levels as demand remains constrained thanks to years of underinvestment in the sector. Meanwhile, the mining sector, it will also be supported by long-term structural trends such as the green transition. And with regards to food prices, they are also likely to stay elevated as repercussions of the Russia-Ukraine war, rising food protectionism, and of course, climate change that is affecting agricultural use. Last but not least, we have defensive sectors. So with a global recession likely unavoidable at this point, we think that investors should add some exposure to sectors that are relatively more resilient in a recession, such as healthcare as well as consumer staples. So moving on to point number 9, we expect India to benefit from a less constructive outlook for China as investors rotate into Indian equities within emerging markets. So India is a prime location for international supply chains thanks to its wage advantage, pro-business environment, and government incentives. The nation, it also benefits from secular domestic tailwinds such as a rising middle class and a relatively young population, both of which should support the long-term growth story of Indian equities, especially its consumption story. In addition, economic reforms such as a reduction in corporate tax rates and also a production-linked incentive scheme should help to drive foreign investment as well. However, despite the many positives of India, the biggest drawback for Indian equities is that its valuations are lofty right now. And with that said, we think that now might not actually be the best time to invest in India. However, given its fundamentals, we think that investors should still keep India on their watch list and look to invest when valuations become more attractive. And finally, to point number 10, we expect the USD to peak in 2023. So the USD has had an incredible run last year. The dollar index has rallied by as much as 19%, and that is actually driven by a sharp rise in policy rates. So thanks to the wider interest rate differential between the US and also the rest of the world, US assets, they have managed to provide a much higher rate of return, thus increasing the demand for the USD. So, and aside from the higher interest rate differential, the robust economic strength of the US relative to other countries has also increased the USD's attractiveness as a safe haven currency. But moving forward, with the Fed expected to slow the pace of rate hikes in 2023, the main catalyst behind the USD's appreciation, it is effectively lost. And secondly, with a weakening US economy, it should also lead to a weaker USD, and this effect is amplified, especially if global growth weakens less than the USD. And last but not least, the wider trend of de-dollarization may also eventually lead to lower demand for the USD in the future. So, last but not least, you can also see that from the chart over here, based on valuations, after a sharp rise in 2022, the strength of the USD has hit its ceiling already. Based on the real effective exchange rate, the USD is now trading at more than 2 standard deviations above its historical average, and that is a level that has proven to be unsustainable in the past. And with the USD expected to decline, investors should avoid USD share classes wherever possible. And with that, I've covered all 10 points of our investment outlook. I genuinely hope that this session has been useful to all of you. Once again, thank you so much for coming down bright and early for FSM Expo. And before I go, I'd just like to wish everyone here all the best in your investing journey, and I hope that everyone can make lots of money this year. Thank you and goodbye.